In this episode of the Ledger Lounge, I'm joined by Katie.
Hi.
And today we've got a very special guest. Managed to get Brendan out of his dusty cupboard at the office, one of the partners at James Scott. So welcome, Brendan.
Good afternoon. They've finally let me do an episode of the podcast.
This week we thought we'd talk about the budget that was held at the end of November. So the dust settled a bit, and we've had time to digest a few things from it. So I think sometimes there's knee-jerk reactions to budgets, and it's always good to give a bit of consideration and to absorb, digest, and see how it's going to impact on our clients. I think we'll just go through some of the main points from it.
It was announced in the budget that dividend rates are going up by 2%, and we've always relied on a strategy at work that we'd pay directors' salary, top it up with dividends. Do you think that strategy is going to change now, Brendan?
I think 100%. Obviously, tax efficiency over the last few years, the strategy was all pay yourself a low salary of $12,500 and a dividend of $37,500. Obviously, there were nuances of different people's circumstances, so it wasn't one strategy to fit all clients. Obviously, each client is individual. However, given the changes in the budget and the 2% increase that you said, based on, a limited company earning a profit of about 100,000 now, the strategy will change, and instead of taking a salary of 12.5 and a dividend of 37,500, it's actually more tax efficient now to pay a salary of 50,000, no dividend, subject to you being able to claim the employer's allowance.
So to qualify for employment allowance, you have to have more than one employee, don't you?
Yes, you need more than one employee on the payroll.
So make sure there's at least two employees.
And the second one has to be earning, I think, off the top of my head, at least £500 or £600 a month.
So above the
minimum
lower earnings level for national insurance.
Correct, yes.
If there's two directors on the payroll, can you not claim employment allowance then?
No, you're
Does
okay.
it have to be a director and an employee, or can it be two directors?
No, it can be two directors.
Right, okay.
Yeah.
So if you've got a limited company with two directors earning in excess of £100,000 to £150,000 profits between them, whereas before it was all small salary and the dividend, because that was the most tax efficient way.
Yeah.
Although, the budgets over the years sort of from successive governments have reduced that gap significantly. However, it is now tipped the other way.
The 2% increase has gone across the board, hasn't it? So at the basic rate, that's now 10.75%.
Yeah.
At the higher rate, it's at 35.75%. Interestingly, the top rate has remained unchanged.
Yeah, the top rate
It's
is
39.75%, I think.
correct, but that's in excess of £100,000, isn't it? So
125?
yeah, because the gap between 100 and 120 is where you lose your personal allowance. So there's going to be different strategies for different levels, but on the basic strategy of someone who earns up to £50,000 a year, I think moving forward, again, subject to the company being able to claim the employment allowance, the irony is it's a £50,000 salary. And that helps in other ways as well, because if you're looking to get a mortgage, a lot of mortgage brokers will prefer directors to be on salaries and dividends.
Definitely. Yeah.
100%. So I know we have issues with having to provide accountant certificates and projections to confirm that the business is going to be profitable moving forward to allow the business to continue to draw those dividends. Whereas if they're on a salary of $50,000 a year, I think most mortgage providers and mortgage brokers are quite happy to accept the pay slips or the P60s, and we don't have to go that extra level about accounting certificates and providing evidence projections moving forward that the client is still going to be able to take these dividends.
Am I right in thinking that they may, if they only take salary in the future, they may not need to do a self-assessment return if that's their only source of income?
100%, because unless you are earning in excess of 150,000 on a salary, you do not need to do a tax return if you're a director and it's your only income is from pay as you earn. You will still be within the system, and it might take a cycle or possibly two cycles until you will drop out of self-assessment.
I thought it was quite interesting, that higher rate, the top rate of income tax, of dividend tax not increasing. And I just wonder whether, given the rhetoric around the budget about those able to pay more are asked to pay more, that they didn't increase that top rate. And I just wonder whether the mood from the city about dividends was, you can't take this rate above 40%.
I think 100%. I think unfortunately, with this budget, there was leak after leak after leak after leak. And when it came, it was, in my attitude, it was a bit, nothing there, but there's not a lot within it. And the people who I think have been hit again are the people earning between 70 and 120,000.
Yeah.
Have been given the biggest burden. Obviously, the changes to the dividend rates, and I'm sure we're going to talk about the changes of the landlord's tax as well. So there's increases there, but again, the main people have been hit again in this budget are the middle income.
So it's not necessarily those with the broadest shoulders.
In my opinion, no. I may be completely wrong, and I'm sure if Rachel would hear, she would argue against that. Yeah. But like I said, the devil is in the detail, and that's why we take a bit of time before we assess the budget.
Do you think a company's still the best route? Because I know we would probably advise people sometimes, set up a limited company, pay yourself salary, top up with dividends. Do you think that's going to change our advice on people that are under that 100 and...
Yes, I would say 100%. I had this conversation with a client last Thursday who has already got a business set up and it's consulting. It's been a sole trader and it had to be a sole trader. And he was taught he has also got a limited company set up, but it's currently dormant and doesn't trade through it. We went through the figures and we were looking at it, and the only reason I think, for tax purposes, he may as well say as a sole trader. The only thing about a limited company is the limited liability.
Yeah.
So if you are in an industry, there's the potential that you could be sued, and you want that protection, a limited company still may be the better option. But it's not as straightforward as it was historically. It's again, it's going to be a nuance for every single client. And I think accountants are going to have to grapple with this, and we're going to have to show the clients, well, if you do this, this is going to be your tax liability. And if you choose to go down the sole trader, this is your tax liability. And if you think about sole traders against a limited company, and you're say a one-man consultant and you use your personal vehicle, it becomes very difficult for your personal vehicle expenditure through a limited company because of the P11Ds, or you just do mileage, and usually most people's expenditure on petrol, on insurance, on wear and tear, the mileage rate that the you can clear from HMRC at 45p a mile nowhere near covers the amount of expenditure you spend on a car.
I think we've talked about maximising income out of your business in the past on the Ledger Lounge, and I think we've talked about making sure you're taking advantage of everything, because now income tax thresholds have been frozen till 2031. There's an erosion of the value of that 12,570. They've been frozen for about 4 or 5 years anyway, so we'll be talking about a 10-year period where that 12,570 hasn't increased. Yeah. So that'll be worth significantly less than it was.
Massive.
I think it links back as well, like we've mentioned it before on podcasts, where we're not just accountants anymore, we're there to actually advise the clients on the best way, the best strategy for them. Would be whatever, X, Y and Z.
Yeah, and I think just looking at things like the trivial benefits, we've talked about that before, where you can pay yourself as a director £50 in a non-cash voucher.
Yeah.
And that's not changed. Nothing's changed on that in the budget, and you can do that 6 times a year. So there's £300 tax-free from your company.
Yeah.
And you can do that for employees as well. But there's no limit on the number of those, as long as it's not contractual.
And to be fair to Rachel, she's been really, really good on trivial benefits within the budget. So, for example, eye tests. Historically, eye tests, employers can pay for somebody if they have to go have an eye test. But it was only allowable for the employer if the employer paid Specsavers or Boots direct. Other opticians are available. However, if employees...
Should have gone to Specsavers.
Exactly. If employees went and paid Specsavers or Boots direct, and then the company reimbursed them, they couldn't get tax relief for it because the employee had paid it. Now, within this budget, she's got rid of all that, which is really, really good. So for trivial benefits, again, I suspect not a lot of people will be aware of that because that's the devil in the detail.
They don't make the headlines, do they?
They don't make the headlines, no. But that's a real positive thing. Yeah. It's something that was always available but was an absolute pain in the backside for employees on companies and businesses because they're not going to have a direct contract with Specsavers or Boots for the eye test, whereas now it's okay. We can do it. Yeah,
a lot of these things were really useful for large employers previously.
100%.
And now a small employer who's not got that direct relationship with a contractual arrangement with a large optician
100%.
So there are some positives.
So
about the budget. It's not all negative.
It's not all negative, and I think we as accountants, we just can't get negative because it's the analogy is it's a cricket game. It's a wicket we have to play on, and it's how best can we navigate that wicket. And there are some positives and small little positives, and we have to take what we have got from the budget and say, right, this is how we advise moving forward. So back to the original question, Katie. Yes, I think it is personal circumstances.
Yeah.
Someone may say, no, I still want to remain on a 12,500 salary and a 37.5 dividend.
Yeah, that could be somebody that, I know you mentioned mortgages before, that could be somebody that thinks, well, I'm never going to remortgage. I've paid my mortgage off, so I'll stick to this. Because it's what they know.
And they say, I don't mind paying a little bit more tax. And that's their prerogative.
Yeah.
Who does?
No, I think it's a really good point you make there, Brendan, about we've got to play the game with the cards we're dealt with. And this is where I think we at James Scott like to get involved and have lines of open communication with our clients all the time. So we're always encouraging conversations.
Yeah.
And in these conversations, points like trivial benefits or eye tests can be brought to a client's attention.
Yeah.
And so that's something that I think we give at James Scott, making sure those conversations are open and regular.
Absolutely.
And relevant to the time of the year as well, right? It needs to be at the right time of the year for the client. It shouldn't be after the tax year when they're in the new one.
It's about working with a client on.
Sorry, I should have told you that 6 months ago.
Yes.
On a regular basis, and I'm sure the clients have all had the correspondence through from us about the budget summary.
Yeah.
How many will read it is, I don't know. It's incumbent on us as accountants to have those conversations.
Well, if anybody is interested in our budget summary, we do have that available on our website. Yeah. Under the knowledge section at www.jamescott.com, so they can go there, download a PDF, absolutely free. It's not behind a paywall or any data capture wall. It's just there. Have a look at it, and if you've got any questions, give us a shout.
Just a little bit to add in regards to limited companies, corporation tax late filing penalties are to double from April 2026. What is it currently, £100, £200?
It's £100 and it'll double to £200, yeah. And I think there's a further penalty after another month of non-filing, which doubles from 2 to 4. And I think if it's 2 years running, they get increased again. So just file stuff on time.
Yeah.
Make sure your information's with your accountant on time. Make sure that they've got the information to provide you. There's no benefit to anybody of working to deadlines and knowing your tax bill on the day it's payable.
Yeah, I think we've probably mentioned it over and over again in previous episodes. There's no point in submitting your accounts 9 months after your year and not years. Take that out.
There might be a big fine for that.
Well, because we're then discussing figures that they're out of date.
Correct.
The year's been and gone.
He'll
The
chip away
contract's
at it
probably
later.
changed, or they're on the last snags of that contract that they lost money on, that they didn't know they lost money on.
People have a choice, can't they? We can produce a set of accounts, and as long as they know where they're at, they may choose. I don't know why, but a director may choose to say, okay, well, I don't want to file my accounts within 4 months of the year end, even though James Scott have produced it. I'm going to wait. I'm going to file them at the last minute.
But you could already we've by that point already done them and had the discussions with them. It doesn't mean that if they don't want them filed within 4 months, then we've done the work though and had those discussions with them. Absolutely.
It's all about going back to communication with the client all the way. But what's the point in incurring large fines for like that? And moving on from the corporation tax, if you think about it, the self-assessment fine hasn't increased since
1996, 97.
And
it's like the mileage rate.
Yes.
45p.
Yes, it is.
So I think if corporation tax is increasing, I think possibly watch this space in relation to the self-assessment
In
fines.
fact, I think our local MP stood up in Parliament and questioned the lack of increase in the mileage rate.
Yeah.
Good for him.
Yeah.
It's less
And
than
I think it was in the relation to carers being penalised because they are providing their own car. They are being paid 45 pence a mile, which is the same that was being paid, I'm going to say 20 years ago, but it might not be 20 years, it might be 15, but even so, the price of motoring's gone up massively in that time. And so you've got somebody potentially on minimum wage as a carer, providing their own car, almost being penalised because the value of that mileage rate is eroded over time. So I think that was the point that he made.
I think he's got a very, very, very valid
it's like
point
district
there,
nurses, they use their own vehicle usually as well, don't they?
Midwives are the same if they're going to do visits at home.
Well, anyone that uses their own vehicle for work.
Which I suppose links back in nicely to what we were talking about before. We've seen sole trader or a limited company, if you're using your own vehicle, it's actually more beneficial to be a sole trader when you can put all your expenditure through, whereas as a limited company, it's probably only putting your mileage through as well, isn't it?
All businesses that employ employees are subject to national minimum wage requirements. And in the budget, we've seen increases from £12.21 to £12.71, which is 50p an hour, either for those are over the age of 21. Minimum wage has seen year-on-year increases for the last 7 or 8 years, I think, in response to a low pay commission report that said they wanted to bring it to a value that was related to the median wage of the country. But what we're seeing now is we had some huge increases that were based around inflation. Post-COVID, we had some big inflationary rises. This time, I think it was about 4% was the increase. But overall, we've now got a rise of 55% over the last 5 years, 5 or 6 years, which is huge. And of course, the top rate has reduced as well from those over 24 to those over 21. So more people have been brought into the full rate. Those are big impacts on employers. They are something that, again, needs to be built into planning with a business.
Absolutely. And you look from the budget, it's all about wanting growth, but a lot of people have pushed back and said we're not going to get the growth and the growth in the number of employees with the minimum wage increase. And I think most people, most reasonable people will agree that it's great that people are earning enough money to survive in this current environment where there's a cost of living crisis. But we as accountants, we have to advise businesses, and unfortunately, it's with the rises in the minimum wages and the costs affecting businesses, sometimes taking on that new employee, it becomes a bit of a barrier to it.
I think it's not only that as well. We experienced it last year with one of our clients. It was like in year one of a 5-year contract with, whether it was a council or I can't really remember, but where obviously the changes to the national insurance last year was massive for him, but he couldn't get more money out of the contract because he was stuck. They'd already agreed it for 5 years. That's going to affect him again this year because he's still in year 3 now, probably, or year 2. Going into year 3 of a 5-year contract that was agreed at a certain percentage of.
So his profits are being eroded year on year. I
think it's just strategic decision making for a lot of companies as well. It's not just based on waiting for that budget to be announced. It's actually looking at, well, if it's gone up by what did you say, 48%?
55%.
55% in 5 years. If I'm going to sign a contract for 5 years, they need to think that that's going to happen again in another 5 years' time.
Yeah.
It is, yeah. And we'll come back to Matthew's analogy about the care worker. So you think the care worker, which is great because it's a massively valuable service, but their costs are all increasing, and then they have to go and negotiate with the council to say our costs have gone up by 15% on our employees with national insurance and the minimum wage. And the council are turning around and saying, well, we can't afford to pay that, so we're only going to give you a 5% rise. Oh, and by the way, we're not going to settle that 5% rise until September, and you'll have paid out wages for May, June, July, August and September before we'll give you your backdated rise to cover that.
Yeah, so and we'll take an early payment charge off it because we've paid it.
Because we've paid it, even though we've paid it. We're 6 months late.
Yeah.
So I think we can all agree that the minimum wage is a positive thing for society.
Oh, yeah.
But it does create problems for businesses, like you said, with KTN, and potentially if you're in the care sector or the construction sector, some impacts on cash flow. So that's where come and speak to us.
For every company, not just for companies that have contracts in place, for companies to actually think, right, how am I going to price this job? Are they going to come back to me in 5 years' time and expect the same price? No, obviously. People's prices go up, but yeah, I do feel sorry for some companies that are now probably thinking, especially if they've got like over 50 staff members.
Absolutely,
it's not just 50p.
You're talking about the AMPs, aren't they? Which are 5-year contracts, which
10 now, some of them.
Wow! So they quote for 10 years up front, and then that's a fixed cost for the 10 years.
There's definitely got to be like. There'll be clauses within that.
There has to be.
There has to be now, yes. I mean, otherwise, business and commerce would just grind to a halt, wouldn't it? businesses aren't going to survive. And ultimately, we want growth. We want businesses to survive and be profitable and employ more people.
Yeah, and I do think that the minimum wage has impacted on employers' decisions to take people on. Maybe even at the lower age ranges, where there's not a massive difference between an 18-year-old wage rate and a plus 21. I think that we saw an announcement that might attract more employers to take apprentices on, where they won't be asked to contribute to an apprenticeship until as long as the apprentice is under the age of 25. So I think that might help people might encourage employers to look at apprentices again, especially as the year one apprentice rate is lower than the minimum wage as well.
Well, it's good because I think we all know that if we've just seen the statistics that have come out recently about youth unemployment has gone up again, unfortunately, and we have to find a way, society and as businesses, to get more young people into good productive jobs and good productive work. The minimum wage increases, while society has been good for it, I think it has been a hindrance to employers taking on young workers, unfortunately.
Yeah, I think when minimum wage, if they are, like you said before, are dealing with the council and there's a ceiling on the amount that the council are going to pay, that is definitely going to hinder taking people on because the business has got to survive.
Business has got to survive, but in the same breath, the demand for services from the council, say in the social care sector, is increasing, and they've got a legal obligation, the councils, to provide those services. And if they're not careful, they're not going to have the providers there to provide a good service. And that's what we all want, don't we? We all want a good service.
Yeah.
To provide, especially if you've got a relative who's unfortunately had something that they need to use those services. We all want to believe that they're going to be provided with the care that we'd give them. It's a difficult and challenging time out there, but I think we have to work with businesses to navigate the increases and the legislation so they can continue to thrive and continue to provide a good service and in a socially responsible way.
Great stuff.
I think we could probably do a whole other episode regarding national minimum wage and
we could, and I think we've got the Employment Rights Bill, which is also about to come into force.
Yeah, the Employment Rights Bill came onto the legislature before Christmas.
So I think we'll look to do an episode that's going to cover that because I think there's some really interesting stuff within that be useful for businesses of all size, which I think some elements of it will impact on cash flow and on decision making.
Definitely.
And we just need to make sure that all our clients are compliant and with all the new rules and regulations that come in, because we don't want anything to happen to their business because, as we know, a dispute or a fine or an inquiry, it's not just the financial cost, it's a mental cost to the client. And it distracts them from running the business. And the reputation as well, I suppose, if they're working we're going back to working with the council and whatnot. Yeah, absolutely. Well, thanks, Brendan, for joining us today.
Excellent, Brendan. And you managed to sit on your hands. Well done.
Just about, yes. So thank you very much. And I'll be happy to come back as and when you need me.
Well, we'll call your agent.
I think she'll say no.
So, see you next time.
The Ledger Lounge is brought to you by James Scott Accountants in Oldham, Greater Manchester. Please like, rate and subscribe wherever you listen to the show. To find out how James Scott can help you build a better business, visit jamesscott.com. This podcast is a QPod production. Visit kupod.co.uk for more information.